Hello everyone, I Sanjay Doshi head the investment and research function at Abakkus Mutual Fund, and I'm really excited to share Abakkus investment philosophy and investment framework, which will guide the investment team in our endeavor to generate long-term wealth for our investors. Abakkus investment philosophy rests on 6 core principles. First, alpha generators. At Abakkus, we invest with an endeavor to generate alpha over markets and not look at allocating within the benchmark index. For this, we try to identify companies which are likely to show higher growth versus market averages or on fundamentally underpriced stocks which have reasonable growth expectations. Second, we're fundamentally driven. We believe that numbers speak more than hype or presentation. And finally, returns are all about earnings growth. We'll follow bottom-up investment strategy with a thorough analysis of annual reports and balance sheets. Third, the risk-reward equation. The return expectation should be commensurate with the risk being undertaken on the investment idea. We focus on what the price is already building in. We strongly believe that great businesses or companies are not necessarily great investment idea at all point of time. Fourth, be agile and flexible. At Abakkus, we are not constrained to any particular theme or style. Each investment idea is looked upon its individual merit, and we effectively adapt to changing investment landscape. Fifth, patient investors. We try to think as partners in businesses, and we look at long-term compounding. While we follow a buy and hold strategy, we would also actively adjust our portfolios to align with market condition if the situation so demands. Lastly, happy to be contrarian. We prefer to be first or only investors. We are open to look at companies across sectors, market caps, and importantly across business cycles. Let's look at our proprietary meets framework, which forms a bedrock for our stock picking strategy. It is interesting to also look at how the meets framework came into place. When Abakkus was founded, the team sat together to list down all their mistakes and learning from the past investment ideas, in addition to those which were a successful investment bet. Thus, the framework also helped us to avoid the mistakes in investing and support overall risk management framework. Let's delve a bit deeper into the meets framework. The M stands for management. Over here, we try to analyze the capability and track record of the management in developing and scaling up businesses. We focus a lot on the capital allocation and capital distribution strategy adopted by the management. Incremental capex is fine provided they support better ROEs and ROCs. Similarly, the capital distribution policy should be fair to all minority shareholders. We also evaluate the errors in decision making from an angle whether they were genuine business errors or they were avoidable mishaps. This helps us to analyze the quality of management and the ability of businesses to scale up quite meaningfully. Second, E, which stands for earnings. Here we look at the quality of earnings versus reported earnings. We try to analyze whether these are structural or cyclical in nature. More importantly, we try to focus on companies where earnings are expected to double in a period of 4 years or max 5, or where valuations can come back or half on EV by EBITDA in the similar period. The second E within the meets framework stands for events and trends. We try to analyze stock movements based on events and expect whether there should be a buying or selling opportunity. We see global environment being very volatile, and it is important to be cautious on disruptive trends and new emerging themes. Finally, returns are a combination of earnings and perception, which is reflected by price to earnings multiples. And a disruptive trend can severely impact expectations and therefore the overall return. The T stands for timing within the meets framework. Again, to re-emphasize, we strongly believe that great company or businesses is not necessarily a great investment idea, especially if the price paid is not right. We strongly believe in the concept of mean reversion, and we analyze very deeply what the price is already discounting. The S within the meets framework stands for structural opportunities. As we look at the macroeconomic development and changing consumer and technological trends, we believe there is a new investment pool which is being offered to investors. It is very important to size the entire opportunity, try to identify companies which have possible unique moats, and this will help us to look at sustainable long-term ideas from a portfolio perspective. As a part of our investment approach, it is also equally important to highlight what we do not do, which helps us to deliver more sustainable and superior risk-adjusted returns. We simply put them as the 4 C's that we do not do at Abakkus. First, chase momentum. We would let fundamental drives our investment decision rather than stock price movement. Second, churn unnecessarily. We avoid unnecessarily churning of portfolios. We look at long-term compounding and have a very disciplined sell approach. Third, copy and mimic. We will not be influenced by herd mentality. All our investment decisions are work independently and internally. Fourth, avoid credit risk. We avoid a fractured balance sheet as we strongly believe that a broken balance sheet is difficult to be fixed and most of these ideas turn out to be value traps. To summarize, our approach is rooted in a disciplined bottom-up process guided by our proprietary meets framework. We emphasize patient fundamental investing with a proper risk-reward balance and aim to create sustainable long-term wealth for our investors through a rigorous research and a prudent portfolio management approach. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.